What up, it's your boy Isaiah, aka KingReubs. Today I'm gonna go over a couple of things that I personally look for before I look for stocks, and later in another video, in part 2 of this video, I'm going to show you how to screen for stocks. Now, what that is basically setting up certain parameters of and certain things you look for in a stock as far as the fundamentals. What type of businesses you want to deal with. As you can see, the market caps, certain market caps have certain businesses. We'll go over that real quick. As you can see, the micro companies are, between $50 million and $300 million. The market cap is basically how much the company is worth. Most of the big name companies are in large cap. There are what's called mega cap, so like these big, basically conglomerates and damn near monopolies, but that's neither here nor there. But mostly in micro and small, you see a lot of what they call OTC, which is over the counter, or pink slips. These are penny stocks worth less than about $5. Real cheap stocks have a lot of growth potential but are very risky. Medium caps, you got your a lot of medium carries a lot of $5 plus to about $20-15 stocks in them. Up and coming companies, or a lot of what I call boring stocks, and I'll get into that a little later. To kind of shorten that, boring stocks are stocks that have very to little, they have growth, but it's very steady. That's why they call boring. They don't go up or down very much. It's just a slow, steady upward trend, which is good for people that don't want to freak out and rip their hair, anything like that. I get into my personal viewpoints, and people trade with emotions, which is one of the worst things you can do, but I'll get into that a little later. Let's take a look at fundamentals. So a PE ratio is a price earnings ratio. As you can see, the formula is market value per share divided by earnings per share. So as it gives the explanation, $43, and the earnings per share is $1.95. The PE ratio is 22.05. Most people or investors go for PE ratios with about 15 at least. That's a good PE ratio you want to look for. That doesn't say companies with lower EP ratios aren't good. There have been many cases over the course of time where companies with lower PE ratios have outdone companies with higher PE ratios, but that goes with, the lower the stock is, the more growth potential, and it does carry a lot of risk, so people tend to try not to deal with that. So 15 is a good number. Price to book or price equity ratio. You see the formula, the stock price divided by total assets minus tangible assets and liabilities. This is to determine whether stocks are overvalued or undervalued, and that's something you want to look for when investing in stocks, especially the long term. With stocks that are overvalued, I've noticed they have a lot of ups and downs, because people day trade, people swing trade and things like that, or what I call that taking it for a ride. They'll, if it's overvalued, they're like, well, it'll go up and down, so they'll buy when it's low on a low day, ride in until a high, and then sell it, slam the market down a little on it. but it comes to a fault with a correction. A lot of stocks have what we call corrections, and it could be any day. It could be weeks, months. It doesn't matter. One day it's going to correct itself, and it's going to drop hard, and then kind of fix itself within the price range. Undervalued stocks typically, a lot of people don't really bother with these. You should, in a way, and you shouldn't, in kind of not way, because undervalued stocks, I mean, there just could be something seriously wrong with the company at that point. Because I mean, if it's a good stock and undervalued, it could just be crappy management, and that that in itself is a company you don't want to invest in, especially for the long term. Profit margin, which is net income divided by net sales revenue. This shows how profitable a company is. Some in these ratios, I should say, vary from industry to industry, and I'll get into that in a later video on the different industries and how some of them work. Certain profit margins are higher in certain industries, such as electronics, than utility stocks, because utilities are somewhat set. They don't go up and down. They're kind of like boring stocks. They don't do much, but they have steady dividends, have steady income, and things like that, and good for long-term investing. Debt to equity is something you really want to pay attention to, especially when dealing with long-term investments. Debt to equity shows exactly how much a company finances its activities. You don't want to deal with a company that has a lot of debt, because it doesn't take much. It could be a small review or something minor, and they could just crash. It typically doesn't really it happens, but not as often as you'd think. But it's something you definitely want to look at. I wouldn't invest in a company with more than. I would be a little wary to invest in a company with a company that has more than 30% debt to equity. It usually gives in a percent form. Return on equity, or ROE, is a formula. Another one gives a percent of how much profit a company can make from investors' money. Return on assets is the same thing, except shows a percentage of how much is made off its current assets. And again, as I put note, all ratios do vary from industry to industry. They're not all the same. I'll get into more in depth in that when I talk about screening for stocks in the next video. Earnings. Beta is the measure of vitality. Higher than 1, the market, the stock moves with the market. Anything less than 1 is less responsive to the market. What that means is, clear example, Apple tends to do what it wants to do with the stock market. I've seen the stock market go down, and Apple's still up because of its low beta. Not all stocks, move with the market. So that's something else you want to pay attention to. EPS is earnings per share, which is something a lot of people look at as considered one of the most important things to consider when purchasing a stock, but it's not the only measurement of how well a stock will do in the future. Revenue growth is another thing that you'll see on a stock screening chart. which I'm about to make in a minute, basically just shows how much a company's made from quarter or annually. It's good books. I've read many books since I started day trading. One is The Intelligent Investor by Benjamin Graham. As you can see, and Warren Buffett, actually when you buy the book, it shows at the top that Warren Buffett, approves it. Stock Investing for Dummies is a good book, and One Up on Wall Street by Peter Lynch is another good book. Again, I want to say I don't have a license. I'm not a licensed broker at all. I do everything on personal knowledge. I ask that everybody that's listening or watching to write down, if you want to get a notebook and write down all the information I'll be putting out. The website that they don't pay me for, and I don't really care if they ever do, but Investopedia.com is a very good website. You can go on a simulator. They give you virtual money, which you can practice with. Again, it has everything you need, from dictionaries to the words to tutorials to videos and examples to everything. I mean, anything you want to think about in the stock market and just finances in general, they have it all there. Again, the website is Investopedia.com. Thank you. If you want, subscribe to the channel. I'll be making the next video within 30 minutes. Keep listening if you want. Tell people that are interested in the African American community, about it. Thank you.